Let's take a conversation forward. Vetri Subramaniam joins us. Let's understand from him what he makes of the current market setup. Is this a good time to increase your exposure to equities, given that Nifty in last 12 to 18 months has given no returns? Vetri, good morning. Thank you for joining us. Vetri, for a market which was looking dull and lull, there were concerns on the local front, on the global front. Have things ironed out now? Whether it is local issues like inflation and Adani stock sell-off, or global issues like US regional banks?
Yeah, good morning, Nikunj. Good to be here. Well, always something going on in the market, Nikunj. If it isn't one controversy, it will be something else, or it could be what central banks are doing. So there's always some controversy going on, and that dominates the narrative. But really, I think, the metric that I would always recommend to investors to focus on in terms of their view on an asset class is valuations. And I think, as you rightly pointed out, with equity markets having gone nowhere for 18 months or more, in effect, valuations have derated because remember, earnings have gone up over the last 18 months quite significantly. 18 months ago, valuations were, I would say, very much in the expensive zone. Today, we are still not cheap, but at least we've pulled back into the comfort zone. And therefore, our recommendation to investors would essentially be that they could continue to stagger their investments. We aren't really blinking green as yet because we haven't really gone into cheap territory as far as valuations are concerned. But this is an attractive area. It gives you some comfort to stagger your investments.
Vetri can't get over the howler that Infosys was. And there has been serious value erosion as well. We were just looking at the PE multiples from the peak and the way they, have collapsed since then. But do you find merit in buying IT at all right now? And more importantly, do you think this is a sector-specific issue or Infi-specific?
Good morning, Aisha. Well, I've been tracking Infosys it's pretty much been a company that's been around all my career. And it's always had this habit of, surprising people very sharply, both to the upside and to the downside with their earnings reports. So it felt like I'd been transported back to another era when, the stock behaved the way it did yesterday. I think it's sort of early days at this point, Aisha, in terms of whether this is, company specific or sector specific. None of the commentary that we've been picking up in recent, weeks, months with the IT sector companies suggests that there's a significant setback at a sectoral level, and the company did call out some specific issues that they were experiencing. I think my operating premise would remain that I think the IT sector is sort of emerging into the post-COVID era on a very strong footing in terms of the growth visibility that it has relative to the kind of run-up we had maybe during the period 2014, 2020, which was a very sober era for IT, so to speak. So, incrementally, we would be a lot more positive towards IT. You're right about the valuations. They were super rich 18 months ago. I hadn't seen those kind of valuations for maybe a decade or more. But I think it's now sort of pulled back to still above average, but again, sort of drifting into the comfort zone. The underlying premise, as I said, is I think the IT sector is coming out of the pandemic era on a much stronger footing in terms of the revenue tailwinds because of the way their business model looks, because of the way their clients are looking to spend budgets. Now, there could be some tremors in the near term. We've seen this in the past as well when economies are going through uncertainty. But I think the structural tailwinds are strong. So I would tend to look for buying opportunities in IT over the rest of this year.
Let's understand the construct of IT and let's take the clock back pre-COVID. This sector was growing in the range of about 8 to 10%. That growth has come back. The valuation multiples for some of the stocks which they currently are commanding have gone back to pre-COVID levels. So looks like COVID has come and gone and the sector is back to square one, 8 to 10% growth with P multiples of 15 to 20 times depending on the company you track.
Exactly. So, as I said, Nico, we would tend to look for buying opportunities in IT. No doubt yesterday's earnings, last week's earnings number were disappointing, but really our thought process would be that IT has a structural tailwind. and there will be an ability to play that. Now, we'll have to figure out which company executes and is able to benefit from those tailwinds the best. But we do think there is an opportunity this year to be accumulating.
There's one bit of a surprise, which Vetri, which is at least something which I've been thinking through. That if I look at the outperformance in last 1 year, ITC right up there, followed by names like Britannia and HUL. Now, at a time when market has taken a decisive relook at value stocks, and cheap is certainly attractive, why have some of the consumer staple stocks which are expensive are still hogging all the limelight? They're owned by FIs, FIs are selling these expensive stocks, yet they outperform. Commodity prices under pressure, yet these stocks are doing well. Am I missing on something? Please enlighten us.
I wouldn't read too much into that, Nikunj. These kind of things keep happening. They will surprise you. The market's never predictable, so it's always going to surprise you with something or the other. But maybe it's also been a little bit of a flight to safety given all the other pressures that we've had in the system recently. But I do think that one of the things which has sort of started to gradually, the pendulum is starting to turn, is that I think the sort of period of the sharp increase in interest rates, which we've seen over the last, again, 12 months, both in India as well as in, by global central banks, is now behind us. And I think what this does is that once you raise the cost of capital so aggressively, the focus has to come back on businesses, not necessarily with blow the lights out in terms of return on capital, but they've got to have some respect for cost of capital. And I think, therefore, some part of the value trade which got a very aggressive bid somewhere during the Russia-Ukraine conflict and thereafter, is going to start to run into headwinds because many of those businesses don't actually generate a high return on capital. They caught a tailwind from commodity prices, supply chain breakdowns. But I think in a higher cost of capital regime, which is where we stand currently, I do think some of those business models will come under pressure in terms of valuations. Whereas the higher ROC businesses, I think the setting is slightly more neutral for them to.
Hi, morning. Wanted to get in your take as well on the capex cycle because we were just talking about, Tim Cook's visit to India, the manufacturing renaissance really picking up. And this is a theme that a lot of experts have been very bullish on. How are you looking to bet on the capex theme in India?
That's an interesting question. I think certainly when I think about the capex theme, in terms of the initial conditions, it's extremely favorable, right? Bank balance sheets are the strongest that we've seen in a long time. Yeah, some pressures in terms of their credit deposit ratios, but in terms of their risk appetite or willingness to grow credit, a strong balance sheet is what drives that appetite, and therefore we have that in place. We also have some of the strongest corporate balance sheets that we've seen going back, almost to the era of 2003, 2005, when balance sheets were very, very strong. So I think the initial conditions are there, but I'm yet to really see, in my opinion, a very strong pickup in appetite for corporate investments by, when we look at the aggregate data. Hard to put my finger on what is holding it back. But maybe some part is animal spirits. Remember, we are going through unprecedented times in terms of the increase in cost of capital. We are looking at a fracturing of global supply chains. Companies are having to reconsider what it means when they operate in this kind of an era. So if I were to put my finger on the missing element, I think the missing element is actually the animal spirits of corporate India. I don't really see the kind of animal spirits we've seen in the past, which is what has driven extreme capex cycles. Now, replacement capex cycle will obviously continue. We are a $3.5 trillion economy. The investment rate is well above 20%. So it's not that no investments happen. It's just not clear to me that we have a significant acceleration happening. And that's simply because the entrepreneur animal spirits, I think, are the missing ingredient.
Tata Steel to raise $400 million in offshore green loan. Now remember, some of these companies are now getting a lot of green loan. I mean, ESG, green loan, better coupon rates. Vetri, on a really, since the news is there, so I'm going to change the topics here. 2 years ago, no institutional investor wanted to buy anything which had coal, tobacco, cigarettes, liquor. Guess what? ITC at an all-time high. Coal India is rocking, NTPC is marching higher. Where are all the ESG proponents?
Well, the ESG proponents may well be holding on to their positions, though very grudgingly, because they're seeing the other side of the market do well. I think there is a bit of a conundrum over there. But, I think the pressure that we see, particularly from global investors, in terms of their unwillingness in many cases to look at areas which they now see as being, challenged and threatened, is for real. And the point that I'll make over there, Nikunj, is that yes, the world still will need fossil fuels. It still needs cement. It needs its steel. But I think the challenge when we look at these companies is that we have to start to now worry about how much regulatory pressure might come to bear on them in terms of raising pollution standards, in terms of meeting much stricter, greener norms, in having to invest just to replace a fuel source without necessarily a better selling price. So a lot of the investments that these companies have to make might not actually create incremental shareholder value because they're only having to replace their existing business model with a much costlier business model. So I think there are some genuine concerns, but you're absolutely right. There is a conundrum here that we haven't yet necessarily found the alternatives. But playing those cycles may be tricky, it may be challenging, and they could be very brief. So I think each investor will have to decide what actually is their tenure, what's the kind of period they're looking at, what's the kind of thought process they have. And I think many of the longer term investors will stick to their thought process of saying we don't want to take the risk associated with the disruptions that business models are likely to face because societies, governments, and regulators are forcing companies to go greener, but it's not clear that they will make incremental return on capital for the investments that they have to make.
Vetri, always lovely to connect with you and look forward to certainly much more of you going forward.
Thanks, Nikunj. Thank you.